Thanks for tuning into the Portfolio Manager. I'm Niraj Shah, and we're doing a slight tweak to the Portfolio Manager, not in the strictest sense. We're still talking to somebody who manages a large portfolio, but it's a sectoral portfolio. And I'm talking about Aditya Khemka, who's been a guest on our shows multiple times. He's from Incred AMC, runs the Incred Healthcare PMS, and joins us right now on the show with his thoughts on this space, which has suddenly become very, very active. Aditya, great having you. Thanks for taking the time out and being with us on the Portfolio Manager.
Great to be here, Niraj. Thanks a lot for having me.
The pleasure is ours. Now, Aditya, let's set the context for people who may not know entirely about the work that you do and Incred Healthcare PMS does. Tell us a bit about yourself and the fund.
Sure. So, Niraj, my background is largely that I worked for the pharma / healthcare universe all my life, 17, 18 years of experience. At Incred, I manage a PMS portfolio, I think one of a kind in India, where we invest only in healthcare stocks, listed healthcare stocks. We started the portfolio sometime in February of 2021 as we got our PMS license, and I have been managing the portfolio ever since.
Got it. Now, Aditya, what's the ethos of you as a portfolio manager? I mean, is there a basic investment criteria that you follow at all times? Tell us a bit about that.
Sure. So the way we look at investing, Niraj, we divide companies into 3 categories of companies, and we follow a 10-point framework, 5 quantitative methods, 5 qualitative pointers on which we score companies. Basis on what score they get, we classify them into great, good, and ugly. Now, ideally, we would love to have great companies at a discount to buy, but the market isn't really a market where it would give you such an opportunity. So we are okay to buy great companies at fair value, close to fair value, so that we can ride the growth in these great companies. Then there are good companies, which often the market gives you at a discount or a steep discount, depending on the market scenario. For example, in a market as exuberant as now, you'll probably get good companies at a normal discount, not at a deep discount. So we are okay to invest in good companies at a normal to deep discount. And the ugly ones or the bad ones, we are absolutely not interested. These are largely companies with either corporate governance issues or very fragile business models, or managements which are not executing well, or other accounting problems or accounting shenanigans. So integrity issues, in other words. So these are companies that we don't buy at any price. So that's basically the framework we follow. It's a framework driven by elimination. We first eliminate what we don't want to invest in. You would be surprised that around 6,500 companies that are listed, if you follow the process of elimination, it is less than 500 stocks, which you end up looking at, because only those many stocks are investable. And then, we go bottom up on those names, and we figure out which other names we want to invest in.
And I presume it's a concentrated portfolio, 15, 20 stocks?
Yeah, it is. So we have about 16, 17 stocks in the portfolio at this moment, but the defined range is between 15 and 20. It is a top-heavy portfolio. Top 10 positions would be about 70-75% of the portfolio. The bottom 6-7 would be about 20-25% of the portfolio.
Got it. Now, because healthcare is also such a wide bucket, Aditya, tell us when you decide to go behind a particular stock. I know you said that it's a bottom-up idea, but within that healthcare bucket, do you choose the quadrants that you want to be present in at some point of time, and if so, what is the methodology, and does that methodology give you any indication of what should people, or what is it that you want to be present in at the start of 2024?
Sure. So look, the 5 quadrants of healthcare that we look at, number 1, unbranded generics, number 2, branded generics, number 3, API, CDMO, CMO, 4, hospitals, and 5, diagnostics. That's how we look at it. The way we look at 3 of these buckets, branded generics, hospital, and diagnostics, we look at them as branded businesses. Now, India as a market is a brand conscious market, and we feel, and we have seen enough and more evidence in the past that the more the brand envisages itself, the more is brand accepted by the audience, the more robust the business model becomes, the more anti-fragile it becomes over a period of time, which is obviously very, very interesting for a shareholder and an investor. So we obviously like the buckets of branded generics, hospital, and diagnostics. Obviously, this is not an absolute statement. There are companies within the sectors that we don't like for the company-specific issues, not for the business model issues. And also, we have to marry our liking of the business model with the valuations, because investing isn't really about just marrying the prettiest girl. It is about finding the best value. So, it has to be a match between the business model and the correct entry point that we get into these stocks. As far as API, CDMO, CMO is concerned, it's a space where we feel there's a lot of tail tailwind. China plus one, even Europe plus one today is a reality. However, the stocks tend to be very volatile here because the business model itself is within quarters highly volatile. You have very concentrated revenues with few customers or few products, and these customers or products can be very lumpy within quarters, sometimes even lumpy within years. So we try to take a more prudent approach here. We try to sort of buy these stocks after bad quarters and maybe trim some positions after good quarters. That sort of balances out our average acquisition cost and average exit price on these stocks. On the unbranded side, we look at these stocks more or less as commodity plays. So, we enter any commodity business when the demand is higher than supply. Unfortunately for pharma in the unbranded generic space, I would say for the past 8 to 9 years, the demand has been lower than supply. The supply has been ever increasing, and that has kept us at bay from entering this bucket. We had in the past taken selective positions because the value was just too deep. But once those value discovery happened, we exited those positions. We booked our profits. We look at the unbranded generic bucket as a trading play. We enter stocks only at very, very interesting prices, and we have an exit price ready when we enter, and we do exit because it's not a bucket where we feel we can be structurally invested over the next 5 or 10 years. So that's how we look at investing in pharma, healthcare in these 5 buckets. In how we are positioned for 2024, I think our largest conviction today lies in diagnostics. I think that's a bucket that has been highly neglected by investors post-COVID. So investors made multiple mistakes in diagnostics during COVID. What I think investors on the street at large did not realize is that COVID was basically a 2 through 5 or 10 year phenomenon. It was never going to be a 30, 40 year phenomenon, at least in our view. And while the diagnostic companies were making extraordinary margins and revenues during COVID, due to the RT-PCR, antigen tests, etc., being mandated by the government, the investors gave those earnings and those cash flows extraordinary multiples of 40, 50, 60 P multiples. To our mind, that did not make any sense because we were not expecting COVID to last 40, 50, 60 years. And therefore, we did not touch many diagnostic stocks when COVID was there. However, post-COVID, what we noticed is that these companies started reporting revenue declines, obviously because the RT-PCR antigen revenues were going away and the normal base business revenues were coming back. And these stocks took a thumping, both in terms of absolute prices and in terms of multiples. They took a very big thumping. And that gave us a very, very interesting entry point into some of these stocks because now the business is base business. Now this business will continue for 30, 40, 50 years. And this is a business you can extrapolate over a very long term. And the profitability basically got restated to what the normal profitability was. So the idea of investing in diagnostics at this juncture is simply that you buy when the profit is below historical averages. You buy when the P multiples or the EV/EBITDA multiples are below historical averages. And as the profit basically restates itself, the margin recovery happens, mean reversion happens. The multiples will also mean revert, and that's basically the holy grail of investing for us to deliver to our unit holders not only earnings growth but also multiple re-rating. So that's one bucket we are extremely bullish on. That's diagnostics. The second bucket where we are highly positioned is branded generics. Again, with the shipping issues, etc., emerging in the Red Sea conflict, we feel that there will be issues with exporters trying to send their materials across the globe, and the shipping cost will weigh on the margins. But branded generic companies largely do business in India, and therefore shipping costs aren't that relevant to them as a cost element. So we feel branded generics will do extremely well in 2024 as well. They will take some price increases. Raw material prices are cooling off because China is supplying chemicals at a steady state. And that will help them expand margins. And again, the valuations here have room to grow for the stocks that we look at. Obviously, there are certain branded generic stocks which are extremely expensive today. So those we don't look at because it's again about delivering returns, not about marrying the prettiest business model out there. So we look at branded generics selectively, but we are bullish on this space by and large because the revenue growth is secular and the profit margin will expand. On the API side, we are bullish, China plus one, Europe plus one, but we are also cautious about what we buy and at what price we buy. So, there are certain stocks which have exited in the past, examples being Laurus, Neural Labs, because these stocks did run up very, very fast and probably were discounting the next 2-3 years of growth at a price point. So we exited at those price points. We don't want to hold a stock which is already discounting the next 2-3 years of growth. And then we are buying into some other stocks with today where we feel the growth is underappreciated, the potential growth is underappreciated, and hence it will probably deliver shareholder value to our investors.
Okay, well, lots of insights into that one answer from Aditya, and it's good to take a break on that note because we have to take one. We come back and try and dissect each of these pockets individually and try and understand what are the timelines that Aditya is looking at when it comes to such businesses, because in the same breath that he said that a lot of these sectors are cyclical, he's also talking about a very long runway for one specific pocket, if not many. So try and talk about all of those on the other side of this very quick break. Stay tuned. On the Portfolio Manager in conversation with Aditya Khemka from Incred. His investment framework is buy great businesses at fair value, buy good businesses at a discount, and avoid bad businesses. He gave us an idea about this in the first segment. Now, let's try and dissect some of the things that he's looking at in the portfolio currently. I'll start off with diagnostics because, Aditya, you said that that is the largest overweight, and you believe now that the COVID bases are out of the way, you look at these businesses from a 20-30 year perspective. Did I hear you say that? Please explain, and please explain what should people who are looking at these diagnostic businesses do when they want to analyze these businesses.
So look, diagnostic business to my mind is a retail business. It's a business about catchment area. It's a business about branding. It's a business about network, referral network, etc., etc. Now, if you look at the diagnostic companies over the past 10 years in India, or even if you look at it globally, right, diagnostics is a very, very concentrated sector. It's a sector which is dominated by few large players and, a long tail of very small players. Now, if you look at the Indian market, diagnostics is a relatively nascent stage sector in India, and you already have the top 4-5 names in diagnostics listed in India. Your Dr. Lal's, your Metropolises, your Thyrocare, your Krishna Diagnostics, Vijay Diagnostics, etc. So clearly, my point here is clearly we feel that some of the larger companies in diagnostics will continue to grow large because it's about branding, it's about network, it's about reach, it's about catchment area. And to invest capital, you need to have capital. And companies which are profitable, companies which make cash flow, will be able to reinvest those cash flows to become more profitable and reach more corners of the country. Now, if you look at India today, even urban India, for instance, the estimates from various reports says that 80 to 85% of the diagnostic market in India is largely unorganized. It's mom and pop stores, standalone diagnostic stores. Now, the problem there is that, these stores may not have any quality assurance. They may have relationships, but they may not have quality assurance. They may not have much of a branding to their customers. So when these incumbents basically grow their network, when they expand geographically, these are the low-hanging fruits that they will be able to reap. And what they will basically do is they will take market share from the unorganized to the organized. And additional measures from the government like NABL accreditations or GST implementations, these are things which will make life hard, difficult for the unorganized players. And that is where the organized players will basically grow faster than the market. They have been doing so for almost 4-5 years that I have been looking at them, but they will continue to grow faster than the market. They'll continue to take market share from unorganized guys. Also, diagnostics as a business, one must understand within healthcare, the journey of healthcare starts with diagnosis. The doctor, the hospital, the nursing home cannot do anything to you unless there is good diagnosis. So this is where the journey of healthcare really begins. And it's an essential service in my mind. And if you saw that in COVID, right? So everything else was shut, barring emergency services. And diagnosis was one of the emergency services that was working. So to our mind, it's a very, very non-discretionary, secular sort of a business where top line growth will be very, very consistent and, barring any black swan events like COVID, it will be very, very consistent. And the operating leverage will help these diagnosis companies grow their bottom line faster than their top line. And that is why we are interested in those stocks. Now, as an investor, when you are evaluating a diagnostic company, to my mind, the first thing I look at is obviously the forensic ratios, the capital efficiencies, the intent of the management, the track record of the management to execute well. But after those things are taken care of, what you also need to look at is how fast are they expanding. So some of the diagnostic chains I know which may not be listed necessarily, but they are very passive in the way they have approached growth, and basically they're not expanding fast enough. And because they're not expanding fast enough, they're sort of stagnating in terms of how much they can grow. Whereas, the companies that we really invest in are aggressive. These are companies that are investing in growth, and these are companies that are investing in geographic expansion. And that not only helps these companies get more revenue and margins and scale, that also helps India as an economy, India as a country. Because it yields better healthcare outcomes. And when it yields better healthcare outcomes, it will help. See, when you try to do something which is in national interest, and it also gives you economies of scale and cash flows and profits, that's the perfect marriage you can hope for.
Agree completely. You've made an interesting choice of the ones that are there in your portfolio, Aditya, on the diagnostic side versus the ones that are not there. So, including one which has got a fairly high proportion, if I'm not wrong, of government-based contracts as well. So, why these companies?
So, look. According to various estimates again, so let's talk about the company which has a lot of government-based contracts. So according to various estimates, about 60 to 70% of Indian healthcare infrastructure is owned in a way by the government, directly or indirectly owned by the government. However, again, according to various estimates that we read in reports, only 20 to 30% of the patient population ends up going to government hospitals. Now, why is that? Why do you own 60-70% infrastructure and yet deliver only 20 to 30% of the clinical outcomes? The answer is efficiency, right? So are they run as efficiently as they could be? Probably not. So I think what the government of India over a period has come to realize is owning healthcare infrastructure isn't really enough. It is a starting point, but it is not the end point. And what they have therefore probably come to realize is while owning the infrastructure is great, if they can partner this infrastructure with private players who have efficient operators, then the outcomes will follow. And I think it all started in 2011 with Himachal Pradesh being one of the first state governments to open a diagnostic PPP contract. And the company that I hold basically bid for that contract and won that contract. It was, I think, a 2 to 3 year contract, but it has gotten renewed 3-4 times in the past decade, and they still, service that state government. You have to understand when you are doing a B2G business, the risk in the business is really that will the government pay on time. Right. But if you look at the financials of these companies, the company that we hold, which does B2G, the debtor days is not more than 90 days ever in the history, not even during COVID. Right. So clearly, the funds are coming from a central allocation of NHM, National Health Mission, and hence the companies do get paid on time. And then when they get paid on time, then the government angle of getting paid on time or not doesn't really appear in data. You can always make a story that it may happen at some point, but the 10-year track record of the company doesn't give us any indication that there is any issue with payments from the government side. So that's number one. Number two, you have to understand when these investors have to appreciate this. I think when PPP, the diagnostic company is working in government hospitals, they are working for a population who nobody really cares about. But they are working for a population which votes, right? Now, any step that the government may take and which can help them garner more votes, my thesis is the government will do more of it, right? So if you are able to provide a private class service to your voting population through diagnostics and achieve better clinical outcomes, the voting population will be happy that you have done something productive for them, and they will probably vote for that. So in a democracy, the view I have taken is that in a democracy, anything which can get votes will be done more and more. And that is what we have seen in the past decade for this company. The way they have grown is phenomenal. And the kind of growth that they're expecting in the next 2 to 3 years is again phenomenal. And that is purely because, we feel that the government will do more of what will get them votes. Also, currently, PPP Diagnostics is at its nascent stage. I mean, some of these contracts that we hear about in some of these states is barely 2% or 1% of the value of the state's PPP diagnostic potential. Right? So it's a dipstick approach in my view at this point, where most of these governments, state governments are just doing a dipstick. They're trying to see if it works. But if it does work and their constituency where the PPP has been implemented, they see a rising voting percentage for their party, I'm willing to bet that the other districts or the other constituencies in that state will also get the PPP contracts going. And that's the potential really we're looking at. So that's why we hold that B2G player, to be honest.
Got it. And maybe that looks better than some of the others that might be available out there. So 2 companies in the diagnostic space in the portfolio for Aditya. Aditya, the other question is, I heard you say that, and you've explained this to us beautifully in the past about how the unbranded generics is a cyclical sort of an FMCG kind of a business at certain times, and certain times a pharma business, so on and so forth. And I heard you say that you've gotten out of them. Now, a lot of people are turning very constructive on pharma. They're saying that the pricing power might be there for some of these companies in 2024. You don't believe in the same?
So for the unbranded companies, I say they are commodity, not FMCG.
Commodity, sorry, excuse me, yes.
Yeah. So for the unbranded companies, I don't feel pricing power is coming back. I know that there is a story going around, or there is some analysis, a theory going around that the pricing power will come back in 2024. But to be honest, I've been hearing that for the past 4-5 years. It doesn't really seem to happen. The economics is fairly simple. It's economics 101. There is no product differentiation, hence it's a commodity. The supply is outstripping demand, hence there is no pricing power. And that is evident not only in the margins or the growth that these companies report, it's also evident in the ROE that they report. because it's very asset intensive. The working capital keeps stretching, the asset base keeps growing, revenue grows, but the margin declines or stays constant. So your ROE keeps declining. And the only reason why I think this theory has come up in the past 12 months is because there has been one large product launch in the US called Revlimid. Now this is a 3-year cash flow. Revlimid goes generic, the patent goes off in 2026. So there is a settlement between the innovator and generic pharma companies right up to 2026. Until that time, Revlimid will continue to contribute meaningful revenue and meaningful margins to these pharma companies right up to March of 2026, I think is when the patent expires. But I think the street has largely mistaken that the Revlimid revenue, they're mistaking it as the improvement in base business. I think that's not happening. See, the reports are again saying, so we see various research reports on how the pricing in US is behaving. And every time the report says there is a reduction in price erosion, right? And hence there is an improvement in the business. That is not an improvement, I'm sorry to say. If your price was eroding 10% last year and it's going to erode 5% this year, it's still a very bad business to be in. Compare that to branded generics where last year your price increases were 6-7% and this year price increases might be 3-5%. Obviously, margins in a business where able to take increases in price will improve. And margins where you are able to, where we have to sort of correct your product prices, your margins will decelerate, they will decrease. And therefore, as an investor, I have absolutely no inclination to be in the space where asset intensity is high, margin is declining, commoditized nature of the business. We only get interested in the space if we find a stock at a price where there's nothing to lose. The margin of safety becomes too high.
Got it. Okay, Aditya, we are out of time, but before we wrap up the show, a 60-second answer. What within this healthcare space you may not have the largest overweight position there because size or just the fact that you may not want to bet too much on a particular horse because of nature. But what within this space is looking the most exciting from a 12 to 24 month perspective? 60 seconds.
Sure. I would say branded generics appear most exciting. Obviously, diagnostics is where we have a very large overweight, but we do have overweight in branded generics as well. So again, they are exciting because we see secular growth, we see margin expansion, and we see scope for multiple re-rating, given that the multiples of some of these companies are still in line to below historical averages. And when that happens and margin improves, you will see earning growth, a faster earning growth than top line, and you will see multiple re-rating, which is essentially the holy grail of investing, as I said earlier.
Okay, and when you say just for the benefit of our viewers, Aditya, before we wrap up, within branded generics, what are the kind of companies so that people have a sense of what you're talking about?
So what we own in branded generics is our largest position is RPG Life Sciences, followed by JB Chemicals, Torrent Pharma, Ipca, Indoco Remedies. These are companies where the India business contributes a larger share of revenue and profits.
Yeah, which is what I want. So viewers, that's the differentiation, that they are not necessarily exporting to other countries, mainly the US and others, in an unbranded fashion, but have a brand of the medicine of their own within India and wherever else it might be allowed, and that's where the larger portion of the business might be coming in. Aditya, so good as always to try and understand a healthcare portfolio from you. Thank you so much for taking the time out and speaking to us today.
My pleasure, Niraj. Thank you.
The pleasure was ours, and viewers, thanks for tuning into yet another episode of The Portfolio Manager.